Michael Kurtz, Chief Asia Equity Strategist at Nomura as well, joins us on the show. Michael, hi, morning. We're staring at 2014 now. How do you see the year panning out for Asian equities?
Well, Asian equities are going to be in a sort of a different situation in 2014. We think that domestic growth in a lot of the Asian economies is sort of peaking out and plateauing, not really rolling over, but no longer accelerating. Which means that it's really the external economy, Asian exports, that are going to be the driver at the margin. The good news is that the developed markets, U.S., Europe, and Japan, all are going to show a pickup in growth. So we think this is going to be a year in which Asia's export economy really starts to pull it along a little bit more strongly. And therefore, as we look around the Asian equity space, it's the export-intensive markets, the Koreas, the Taiwans, that we think will probably do better.
Do you expect emerging markets to outperform developed markets in 2014?
I think rather than, sort of treating all emerging markets as one unitary asset class, we have to start differentiating within the emerging markets. So while EMs overall probably will underperform, within the EMs we could have some very strong performers and some continued relatively weak performers as well. So we are underweight the EM asset class in Latin America and neutral in emerging Europe. But here in Asia, we're actually somewhat overweight, albeit with a very strong preference for the EMs that have more of an export component rather than the sort of heavily domestic emerging market stories.
In your report, Michael, you've said that Asia's policy makers have an opportunity to shift their focus from growth back towards financial stability. But in case of India, which is all set to go in for elections in 2014, policy might take a backseat. Is that why you expect growth to lag?
Well, India's lagging growth is really a function of some very deeply entrenched structural problems with the economy. Most importantly is the almost complete absence of investment now in India, partly because of the sort of echo effect of the anti-corruption investigations of several years ago, and partly because of the persistence of very high interest rates in light of India's structural inflation problem. So growth is probably likely to stay low, although in India we think GDP at this point is probably at least bumping along the bottom. More interestingly, from a policy perspective, is going to be whether or how the new RBI governor, Raghuram Rajan, is able to deal with this structurally entrenched inflation. And then looking beyond the national elections in May, whether or not a new government, or for that matter, any persistence of the existing ruling coalition, may begin to try to attack India's structural growth problems from a reform perspective.
You believe deep value argument for Asia equity has played out? And if so, what will drive them down? Will it come down to earnings?
Well, it will be earnings, absolutely. The sort of flip side of the progress that the global economy has made over the past several years is that there's just not enough upside for equities any longer from what we call risk compression. Risk compression basically means the big scary risks like a breakup of the euro area or a hard landing in China have been getting smaller. And as they get smaller, equity earnings multiples have been able to expand even without the earnings growth. Now we really do have to look to the earnings growth to be the driver. And we're not going to find earnings growth equally around all the markets in the region. Exports can and almost certainly will be a critical driver of earnings as we look out over the year ahead, because it is in the external economies where we see more of the upside. And so we want to look for corporate earnings, particularly in places where you get a combination of sales growth driven by exports and potentially at least some bottom line profitability enhancement from lower input costs. And that means sectors or companies where you have, let's say, a fairly large exposure to either commodity prices or energy prices, where we think that there's still some downside risk looking out over the next year.
So this holds even if Fed announces tapering on Thursday. Will fund flows to emerging markets take a hit in that case?
Well, I think we're seeing that already. The fears of a Fed tapering exercise have already, I think, induced investors to sort of default back to the positions that we saw being taken over the summer when tapering concerns really became a front burner issue. But I think if we take a somewhat more medium-term or even longer-term perspective here, we need to keep in mind that the reason why the Fed seems about to start moving ahead with tapering is because growth in the United States is now strong enough that the artificial support of QE is no longer nearly as necessary. That growth ultimately will itself be a source of corporate earnings and a source of exports for Asia. And at the same time, remember that as the Fed tapers, the dollar is very likely to continue to strengthen, and a stronger dollar historically tends to push down commodity prices and often energy prices as well. So from an earnings perspective, we also can take advantage of that by looking for sectors where lower commodity prices or lower energy prices are a positive for their profitability.
Are countries like India better prepared now to absorb the taper trembles?
You know, unfortunately, I think for much of Asia, the time gap, if you will, between the summer tapering episode and the imminent tapering episode has been too short for policymakers to really make substantial progress on structural reforms that typically take a very long time to address. In India's case in particular, there has been a change of personnel at the head of the central bank, and clearly the new RBI governor is enjoying a pretty strong honeymoon period, I guess you could say, with investors. There's a perception that he is trying to implement a kind of a regime change at the RBI, in which he seems to be focusing much more on currency stability specifically. And I think for the time being, markets are sort of taking him at his word. But at the same time, we have seen the rupee pull back a bit in recent weeks as the taper begins to become a front burner issue again. And I think India is going to remain somewhat hostage to the outlook for tapering. The greater hope, I think, not only for India, but for the other current account deficit plagued Asian markets, is that the outlook for Treasury yields and for tapering going forward may already be pretty well discounted at this point. Remember, over the summer, markets were taken by surprise. But since then, we've now had 6 or 7 months to discount and prepare for the tapering. And of course, over the summer, U.S. Treasury yields rose by 130 basis points in the short space of about 3 months. We're not looking at anything like 130 basis points of additional upside from where we are right now.
Michael, we have the RBI mid-quarter policy meet tomorrow. Are you prepared for a bump up in rates, and how do you see the rate cycle for 2014 panning out?
Well, there's certainly additional upside risk to Indian interest rates, and I think, frankly, that that's the right thing for the RBI to do. We don't necessarily see one tomorrow, but I think what's important is that the Indian central bank under Rajan is beginning to focus much more on currency stability itself. With currency stability, ultimately becomes more stability in terms of cross-border capital flows. Investors are much less likely to pull out of the market if they have more confidence that the currency will remain stable. And of course, at the same time, with currency stability over the longer term will come more credibility for policy and ultimately lower inflation expectations. So if we do have to pay the price of a little bit more upside on interest rates in order to achieve those longer term positives, I think that those would be interest rate hikes very well justified by the outcome.